from Armored Wolf. John, you see Swiss stronger. What does that signal to you when you see the instability within Euro-Swissy?
Well, obviously, Switzerland's an island of strength within Europe. It's not beholden to the currency, and it's not beholden to the union in terms of bailing out the periphery countries. So what I see happening in Europe is really an all-for-one, one-for-all type of policy. So there's some acknowledgement that the ECB is taking on collateral from the periphery countries, and ultimately that means a weaker euro currency.
How are you playing it without getting into the nitty-gritty of your hedge fund activities? What's a strategy that makes sense when you see the turmoil in Europe?
Sure. Well, I mean, most investors are going to be simply focusing on, is Europe going to be successful or is it going to fail, and a widening or narrowing. I'm actually looking more for what I'd call convergence, which is to say that there's not that big of a difference between the German and French credits and the Spanish and the Italian credits, as an example. That's a trade we have on where we're essentially saying that we think that the German and the French banks and population are going to end up becoming the same credit as the Spanish and the Italian banks and sovereigns.
Bring up Barry Eichengreen, if you would, Rex, and William, if we can bring up the op-ed piece from Barry Eichengreen, this in the national interest. Mr. Bernanke goes to war. Strong language from the professor from Berkeley. What we are seeing now under the moniker of international currency wars is the last gasp of Bretton Woods II. The U.S. can no longer afford to be the world's consumer of last resort. This is how, John Brynjolfsson, how we tie ourselves into turmoil in Europe. I mean, we're really not removed from Europe, even though we'd like to be distanced by the Atlantic Ocean.
Well, at the end of the day, I think you've got four major currency blocks in the world. You've got the dollar in North America, you've got the euro, and then you've got the yen, and then the fourth new block is really all of the emerging market currencies, and I'd even lump in commodities and gold with that fourth block. And it's the fourth block which is the most interesting these days. That's what the Chinese are focusing on. That's what that really seems to be the only currency that's not laden with bloated bad assets.
Yeah, let's bring up dreaded first chart here, folks. Bond flows slow, finally. And, John, you nailed this. You were on with us here a bit ago, and you really nailed QE2 and what it would do to the markets. We've seen a round trip on interest rates with QE2. Why did yields go higher if Ben Bernanke wanted them to go lower?
Well, really what Bernanke and the Fed can control is the Fed funds rate, first and foremost, the value of the dollar, even though technically the Federal Reserve is supposed to leave that to the Treasury, but the reality is that the Fed controls the value of the dollar as well. And then the longer bond yields are really a function of inflation and growth, and those are market determined. And to some extent, Bernanke's goal was to get inflation from that 1% rate or even the 0.6% rate on the core up towards his 2% goal.
Well, when you look at the chart we just had up, dreaded first chart, and you look at bond flows with prices lower, yields higher, I mean, everybody's taking it on the chin here. How do you play bonds right now, John? You see your former colleague Bill Gross, his total return fund, a little off the mark. Can you be opportunistic here, or do you stand aside in bonds?
Well, we think being long duration just naively and in a buy and hold situation is foolish. I mean, when less than 2 months ago, the 10-year was yielding 2.50.
Right.
And the idea of locking in a 2.5% yield for 10 years was foolish, and obviously resulted in capital losses in the meantime as those yields backed up all the way to about 3.50 a week ago. So, yeah, you want to play it as a curve strategy is the best way I see playing it, where you're actually short the longer end of the curve, the 10-year and 20-year and 30-year sectors of the curve, and then you're long or at least on sides with shorter instruments. We like to own some of the 5-year tips, for example, where you've got a deflation floor and you've got some inflation upside.
We're going to come back and look at some of the pictures behind the actions of John Brynjolfsson. The idea of corn and wheat moving higher today, those commodities really clicking in with a picture of future inflation. Also, we'll look at the five-year break even, that idea of the whispers of inflation out there. That's right, I'm watching corn. Here it is. It's up 2 more cents just since Bloomberg surveillance this morning, $6.03 a bushel. We're going to come back with John Brynjolfsson.